kick it off. Excited. We've been having a lot of fun with these broad-based client webinars on different types of planning topics, investment topics, and we just finished a very interesting three-part series that was really all about health and wellness and managing your energy and your focus and nutrition. And that one we got fantastic feedback on, and I certainly came away with a lot of notes in terms of things I need to work on to up my game as a corporate athlete. So this is great stuff, and I'm excited about this one. We really got an all-star group here. I appreciate these fellows for joining me. This is like the dream team. I feel like I'm Judge Lance Ito or something here. So I don't know. We should have a good conversation, and I think with the group here, we will certainly do more than scratch the surface, but hopefully take a really significant gouge out of it. But there is a lot here that could be discussed. And so by way of disclosures that are friendly compliance department, always make sure that I throw out there, this is informational only, nothing here is intended to be specific advice. This is a complex area. Each person's situation is unique. Each state is unique and is different. So the facts and circumstances, you really need to consult with professional. We got a great group here, so some tremendous resources for people to follow up with, and we're always happy to have these conversations. Maybe another disclosure: we have people from several different entities here. Cahill Financial Advisors. We're hosting this. We're delighted to have these folks in as guests, but there's no financial connections between any of us. Cahill Financial Advisors, we're not employees of PIMCO or Maslin Law or Ellingson, and vice versa. So we're all just here for an idea sharing session. So with that, maybe by way of introductions, I got my cheat sheet here. So John Ursessian is with PIMCO. I believe your title, John, is Head of Advisor Education. Is that correct? And I've been listening to John and coming to his workshops for years and years and years. I think the first was probably almost 15 years ago. I went down to Chicago and sat through a day-long investment presentation. And so John specializes in teaching financial advisors, and he is an advisor's advisor, very sharp, excellent presenter, and we're delighted to have him on. He's also part-time faculty at University of Chicago Booth School of Business, where he's been very involved in one of the top professional designations in our field, the Chartered Private Wealth Advisor. So, and then Mark Gassner. Mark is a certified financial planner and a CPA. And Mark, glad to see you doing well. You survived. You made it through. How was it?
Yeah, it's always different. I think this year was unique in that we've had two extended filing deadlines from July to May, and now we're back at April. So a lot of learning through it all, and still standing. So have that going for me.
Good. I'm picturing like you got to Monday, 12:01 Tuesday morning, and you slept until about 10 minutes ago and logged into this. But really appreciate you being here. I imagine that's just a tremendous workload and a lot of stress. But welcome. Having your expertise and knowledge. And if I didn't say it, Mark is with Ellingson and Ellingson, a Minnesota-based CPA firm, a great family firm with a long history. And then Mike Sampson. Michael is the head of the estate planning group at Maslin Law Firm, and longtime acquaintance, personal friend, and Mike and I are the same age, something we always talk about. We're a day apart, so we both hit the mid-century mark here, and so we have a lot to commiserate about. So, and Mike is also an adjunct law professor at Mitchell Hamlin, so very sharp. Mike does a lot of presentations and has a wealth of experience with affluent Minnesota households and people across the financial spectrum. And I think that's the things. We have the nuts and bolts. We probably also have a lot of personal stories to share and tell, both from clients and things like that in terms of relocating. So, maybe on to the topic. So we just got through the tax deadline. John, here in Minnesota, we're still getting snow. We had flurries blowing around. If I go to the weather app on my phone, this is a pretty good day. I mean, see, at 44, drizzly, overcast, but you are in Naples, Florida. And what is it?
I've got some I've got some evidence for you right there. How does that look?
Okay, not bad. I see sand, I see ocean. And I imagine, if you're getting ready to tee up this afternoon, or you stroll down to the pool in your flip-flops and you're slathering on the sunscreen, and you're commenting about the weather because everyone talks about that. And you talk to some other residents, you say, oh, man, that tax bill, the filing, what did you have to pay into the state? And what's their answer going to be?
But down here, the answer, of course, is zero.
Zero. I mean, I think Mark and I are having conversations with people who paid in tens and thousands of dollars, sometimes more, to the state of Minnesota. So,
yeah,
maybe because you have a very broad scope, you're nationwide, you have some personal experience. You want to start us off with maybe just a bit of a conversation about what you're seeing, people moving. I've heard you use this term relocation boom.
Yeah, there is a relocation boom underway. And in fact, here in Florida, not to suggest that this is the only destination where people are coming. As you know, Florida is one of 7 states that doesn't have a state income tax. You've got, of course, the great weather down here. You've got folks who are leaving for a variety of reasons. In fact, I think I heard the number recently. There are 1,000 new residents arriving in Florida each and every day. And I showed you the beach a few minutes ago. If I turned my camera on, I showed you Route 41 or the downtown area of Naples, Florida, you would definitely see an uptick in traffic.
Mm-hmm.
Now, there are a number of reasons why people are maybe contemplating relocation. Number one, of course, is the idea that we're more flexible today. If we're still working, we've got that opportunity to work remotely. And so that affords people a new opportunity. You've got the baby boomer generation, and I guess I'll include myself in that as well. I was born in 1958. I'm 63. I know my beautiful suntan makes me look younger, but I'm part of that. I'm part of that equation as well. So that demographic of folks who are leaving the workforce have the opportunity to kind of pick and choose where they may want to live in retirement. And then the third impetus, and I'm not suggesting that this is maybe the most important, for some it might be, for others not, is the idea of state income taxes, right? And so I relocated from Illinois down to Florida. I did it 5 years ago when I left my employer, who happened to be in Illinois. And my kids had graduated school. I was no longer getting a W-2. I had bought a home in Florida. I checked a lot of those boxes. And I know our 2 friends, Mike and Mark, are going to discuss what those steps might be. But you're absolutely correct. There is a relocation boom underway. Now, I do want to offer some caution. I would hate to see somebody relocate from the beautiful state of Minnesota or Illinois or wherever they happen to be domiciled and wind up in Austin, Texas, or Naples, Florida, simply for tax benefit. There was a recent study done regarding retirement fulfillment, and they talked about a number of key issues that these studies suggest lead to a fulfilling and a happy retirement. One of them, of course, is finances. And so that might be a motivation for people to consider relocation, but there are other key considerations as well. Number one, your family. Where are they located? Got a grandkid who's just born in Illinois. I'm not so sure that saving a few dollars in taxes by moving to Punta Gorda, Florida, is necessarily going to be an appropriate step for me. Next is health. Where am I able to live a more healthful life? And then last but not least on that list is purpose. And so I want to make sure that even though all of us are involved in providing financial counsel, we don't let finances or taxes be the only determinant of this decision. I hope that provides some context.
Yeah, I think that's great. And John, you're dead on. I think we talk about a lot of technical issues. We spend a lot of time thinking about them. Personally, I love the problem solving and the puzzling of the analysis side, but we're very much in a human business, and I think you're dead on. What brings happiness and fulfillment in life and successful retirement is so much more beyond the numbers. But I have found in my time, I have 2 broad categories of clients who complain about the taxes and paying the state of Minnesota, and they tend to be men and women. So it is a real it is an issue. It's something that comes up. But one of the things I find interesting, Arizona is very popular with Minnesotans, and we've had a lot. And Arizona is better than Minnesota tax-wise. They don't have a mosquito population, and it is sunnier and warmer. But even with that, a lot of people spend considerable time there, but still don't quite go through the extra steps to establish residency. It doesn't seem to be a big enough benefit, and I think it's a lot of those things you you talk about, John, that often it's family, it's personal connections, it's more than the dollars. But Mark, you are the guy who's filing the returns, delivering the pleasant news on state tax bills. I mean, what are your thoughts in terms of where Minnesota falls, what you're seeing, maybe some thoughts about the actual compliance and what needs to happen to lower that bill?
Yeah, I mean, I think as John referenced, the decision can't be a be all end all of solely on income taxes when it comes to a residency standpoint. Certainly Minnesota is one of the highest income tax states. And then even if we look, as Mike may reference, into state taxes, it's another area where I think the bigger focus we always start is kind of long-term planning, asking the whys, but also figuring out if there's anything they can do that still meets their long-term goals, whether that's charitable giving or coming up with different strategies that allow for a benefit, even so if you're a Minnesota resident. I've been here my whole life. I'm still early in my career, but at the same time, I have plenty of clients that are digging into that conversation of residency, but at the same time, are there tax mitigation strategies that you can use that allow your dollar to go to the purposes that you do care for? That could be gifting to family, but also at the same time, some charitable planning there. I know that's outside of the scope of a residency question, but I think it's also very important because it's part of the issue too.
Very good. Very good. And maybe from a high level, so Mike, I know, you are a estate planning attorney, but from having had many conversations with you, I know your scope of advice and the conversations you get into are very broad, and you're an old guy now. I mean, what have you seen over all these years in terms of your conversations around planning to move or not? Is that a big factor? Is it a key topic?
Yeah, and one of the things that we're fortunate about in Minnesota is that we have so many successful businesses that were born here and that grew up here. And a lot of times when the business owner, the founder, gets to be a certain age, or as one of my clients said, the stupid money comes out, the private equity funds come and offer a number that they just simply can't say no to. These clients are selling their businesses and liquidating their life's work, and a lot of times that becomes a motivation for people to want to move. It's one thing to avoid a 9.85% marginal income tax rate every year for 30 years. It's another thing to avoid a 10% bite out of the proceeds from the sale of your company. And I've seen a fair number of people move out of Minnesota in their 60s, to sell their company, and then move back here in their 80s to be by their grandkids, or to be, by the Mayo Clinic, or whatever it might be. So I think about the distinction between moving to another state where the tax environment is more favorable, and moving to another state to avoid a one-time event. To be completely honest, the Department of Revenue in Minnesota is well aware of this motivation, right? And so if your real goal is at some point in the next 3 to 5 years to sell a significant asset, a company, real estate, whatever it might be, and you'd really like to not be a resident of Minnesota when you incur that income, you've got to start a couple of years before. You don't want to say, I moved out of Minnesota on March 1st and I sold my company on March 10th. That's just, not going to fly with the Department of Revenue. So I don't know, I'd be interested to hear what you think, Mark, but I've always said a year or two, if you can move as a part-year resident, in 2022 and sell your company in 2024 or 2025, that's going to put you in a much better position. And then the other thing is that people, you need to understand that the distinction in Minnesota is between domicile, which is where do you think of as home? It's sort of a hard question to answer, but where do you intend to remain indefinitely? If you left the state and you said, I need to go home, where would that destination be? Minnesota Revenue talks about your heart's home, right? They look where you keep your wedding certificate, where you keep your pictures of your kids, you know, where you keep the stuff that people think of as home. And so if you're going to move, you have to change your domicile. It doesn't matter how many days you spend outside of Minnesota if you haven't done the steps to change your domicile. Only if you've changed your domicile do they care about how many days you've spent in Minnesota, right? So it doesn't matter to count days. I had clients once that said, we're going to sell our house and buy one of those big mobile homes, those RVs, and we're just going to drive around the country. We're going to be in Minnesota for the nice 4 months of the year, and then we're going to just drive around the country and tour. They never changed their domicile. Your domicile is where it is until you change it. And if you aren't spending much time in any one place other than in your RV, your domicile is still here in Minnesota. You can't get around it by buying a parking spot at an RV lot in South Dakota if you never go there, right? So it takes work, it takes effort, and you know, anybody who's looked at Minnesota law will tell you there's 26 factors that you have to look at in order to decide whether you're domiciled here or not. And sometimes clients say, why are there 26? I said, because they're numbered A through Z. If there were more letters in the alphabet, there'd be more factors. And they're not weighted. They're, you know, they're all just listed. And, you know, they don't really tell you which ones are the most important, but certainly where you spend the most time is critical. Where your family lives, you know, I've had people say my wife and kids are going to stay in Edina and go to school, and I'm going to move to Florida. That's a tougher argument to make than if everybody picks up and sells your house and moves. So you know, I guess it takes planning and execution to do it if you're doing it for that one-time event. If you're really just moving because you just can't stand winter anymore, you know, you don't have to worry too much about the 26 factors. If you sell your house and move everything, and you know, what people seem to want to do here is keep their house on Lake Minnetonka as a cabin, and you know, buy a condo on the beach in Naples, and say, you know, now I live in Florida. Well, I had an audit once where the person had a $10 million home on Lake Minnetonka and a $500,000 condo in Florida, and tried to convince the Department of Revenue that they lived in Florida now. And what we had to say was, hey, we can't help it that real estate on the shores of Lake Minnetonka is valuable. It's not his house. It's his summer place. You know, who are we to say that that's a bad investment, right? So you do have to make those arguments, but you hope your advisors can make the arguments without blushing. Yeah. That's kind of the test, right?
It's interesting. And so we are probably going to focus mostly on Minnesota. That's where we have a lot of mutual clients. And different states are more or less aggressive. But in kind of thinking about this and leading up to this, I heard of a case in New York where I believe it was a Floridian was sent up the river for white collar crime and sent to a prison in New York State. In New York, tried to start taxing him because he still had income while he was incarcerated. And it was a multi-year case. His attorneys would say, look, he's here against his will. He's sitting in a jail cell. This is, you know, so I mean, different states are more or less aggressive. I think a couple things, Mike, I really like the point of, you know, in what we do, there's so much interdependency of recommendations and sometimes conflicting benefits or disadvantages, and the idea of yet seeing that tax return each year. You know, they may feel like the death of 1,000 cuts of filing to the state of Minnesota each year, especially if you're hitting that 9.85%. But we also have to think of balance sheet, and that's what you're talking about. If you have balance sheet assets there, a significant portion of wealth that has been accumulated through, you know, Fortune 500 company or, you know, private business or something like that. That's, I hear what you're saying, Mike, that it feels probably like you're about to drive off the cliff if you see a, you know, 10% whack come out of that, or to your point, estate planning, right? A whole nother tax system there to consider if you have taxes over there. But that's good. Any other thoughts on how to cut the ties? Because Mark, I'm sure you could say, well, you need to file a partial year return if you're heading down to Florida or Texas or Tennessee or Nevada or one of these no state, but there's more to it. Mike went through quite a bit. Any other thoughts or stories to share on that topic?
I would just second what Mike said about really pointing to that they don't have a bright line test, and there's a reason for that. Is we all hear the 183 days, or and that's what clients may bring up, but it's certainly more than that, especially if there's material dollars at stake, especially in the case of a business sale or whatever it may be. That if it matters this much to you, then it does take the investment in taking the time, being proactive about it, and planning for it to just make sure that you're checking off as many boxes and that you're keeping the documentation for it all too. So.
And Mark, I love that comment, and Michael alluded to it as well. And I'm referencing this because I hear it every day at the golf club, with my friends on the driving range, or at lunch. 6 months in a day. I mean, how many of you have heard that expression, 6 months in a day? And it's a misnomer. There's nothing in the tax code that says specifically, if you spend 6 months in a day in one state or another, you have changed your state of residency. There's a lot more to that equation than simply time spent. My brother owns 4 homes in California, Florida. He's got a place in Palm Desert. He's got a place up north as well. And he doesn't spend 6 months anywhere. I spent 6 months in a day in American Airlines seat 3A. And last time I checked, that's not a state of domicile. So the point, I guess, that I'm confirming or reassuring your friends of is the idea that there's a lot more to this. It's this intention to live a life in a different location than maybe where you were previously located. I've got a little slide I wanted to share real quickly too, Scott, and then
You bet.
maybe this is helpful to our friends on the line with us. This is a little chart that we had put together showing the various states. I know that our friends on the line with us today are from Minnesota, but take a look at this chart. You can see I guess is that silver or light gray? Florida, Texas, Nevada, Washington.
Yeah, maybe gray. Yep.
You can lower my taxes to something below 0. I'm still not moving to Alaska, but that's one of the states as well. And I do love the reference that our friends have also made. Initially, this is the impetus. People look at a number like 985 in Minnesota. They look at Texas at 0, and they look at Florida at 0, but that is just a cursory observation. To Michael's point, you got to go a lot deeper. I had a friend in Illinois who was retiring from his job. And he said, John, I'm going to follow you down to Florida. And I said, well, time out for a second. Let's review the fact pattern. I said, when you stop working later this month, tell me about your income. You're no longer getting the W-2. His income is going to be retirement account distribution, Social Security, and a pension. And none of those are subject to the state of Illinois' state income tax. And so there are other factors at play. Don't just look at these gross numbers and draw that gross conclusion that I'm better off in Florida than I might be in Illinois or another state. That's
well, and very quickly. So income tax, like you say, different types of retirement income are treated differently. You've got property taxes, there's sales taxes, estate tax can be a big consideration. And then you get into a whole other factor, cost of living, healthcare, your what you like to do, your activities, your arts and entertainment, political affiliations. There's sort of a whole gamut of things. Mike, I know when we were kind of talking about this beforehand, you brought up some great points about some of the community property versus separate property states. And what do you have to share with us on that front?
Yeah, I mean, there's a lot more to where you live than just the income taxes you pay. If you're married and you move to another state, on your chart, Texas was one that has no state income tax, says no estate tax at the state level. A lot of people look at moving there, but Texas has community property rules that govern the ownership and disposition of property. If you're from Minnesota and you move there, you have separate property. What's in your name is yours. What's in your spouse's name is your spouse's. And when you move to a community property jurisdiction, you could change that. You could convert it to community property. Community property is really just a question of who owns what. And think of it as Texas views married people as a 50-50 partnership. So does California, Arizona, Louisiana, Washington State. You can opt into it in Alaska. There are 9 states in the country, Idaho. New Mexico. So there's a few of them, and they basically say married couple is a partnership. Anything you acquire after you're married, you own 50-50. So Scott, if you and your wife owned a house and you were residents of Texas, and you died, you own a half interest in that house and she owns a half interest in the house. She can give her a half interest to whoever she wants. And you can give your half interest to whoever you want. So if you have assets that you've accumulated and you have a prenup, for example, you're married for a second or third time, going to a different state may change the rules, that apply to assets that you acquire. So that's an important factor. And then you mentioned too, how do you do your estate planning? If you've got wills that were written in Minnesota and you move to Arizona or Texas, you probably want to have them redone. Not because your Minnesota wills aren't good in those other states. They would be enforceable, but they may not work the way you intend them to work. So, there's a lot of that sort of stuff that goes into it. And I think, when we were talking before about domicile, it's like anything in the law. We're trying to establish a state of mind. And no matter what conspiracy theorists think, they can't tell you what you're thinking. They can't just look in your head and tell your state of mind. The way they measure state of mind is by your behavior, by your objectively observable actions. And so, if you're going to move to another state, you better get a driver's license there. Not have your mail forwarded, but change the address on your mail. Get a doctor that you visit down there. Vote, register to vote. One thing we talk about sometimes is changing if you're a member of a church, joining a church somewhere else. Good luck getting your name taken off as a member of your home church. I think you can't really ever give up your membership, but there are lots of things like that people do. And they say, well, I've got my driver's license, I'm good. No. That has, just scratched the surface. But I would certainly say updating your estate planning documents would be a step that would show, hey, I intend to stay here. I intend to stay here indefinitely, so long that I might actually die here, right? I think it's a helpful step. Note that the Minnesota State Bar Association lobbied hard to say that where your lawyer is located is not a factor. You can continue to work with a lawyer, a financial advisor, an accountant, a bank in Minnesota, even if you live in another state. You can also continue to give money to Minnesota charities, even if you live in another state. So we've carved out a couple of things that say these are off limits. Of course, who wrote those rules, right? We did. But it isn't a bad idea to have as many connections in that new state as you possibly can, because if they're going to look at it, they're going to look at everything. And the more you can put on I think Minnesota's scoring system is favors Minnesota or neutral, right? They don't really say, oh, that favors Texas or that favors Florida. It's sort of like, oh, this is definitely Minnesota, or, it's neutral. So that they definitely have their thumb on the scale. And my law firm has handled lots of state residency audits. And they really look at everything. Like I had a client who, always got his cigars from a tobacconist in Wayzata. Why don't they sell cigars in Florida? And he said, no, but he knows what I like. Or
they can subpoena records, right? Credit card statements. They can look at airline tickets to see when you're traveling. They can subpoena cell phone records, which have tracking to see where you're actually at. But so what are we actually seeing here? Because it seems like, okay, if you move completely, you're retired, it's fairly clear. The issues are if there's some spending time in both states, or maybe there's certain property or business still in Minnesota and you move, that's where it kind of creates this entanglement. But presuming I or someone decides to make this move to Texas or Florida or wherever it may be, I say, here I am, I'm going to stop filing my Minnesota return. How often are people, do we have any type of numbers or anecdotes about, how frequently are these cases actually being taken to court, or people being audited? What is the risk, I guess I'm asking?
Yeah, Mark, what are you seeing? Because I'll tell you, my guess is that it depends on how many zeros there are in your income.
Yeah, I think the risk is at different levels. From Minnesota Revenue's point of view, they're trying to find additional tax dollars. That's their objective. And they want the return on investment to make sense in their eyes. So from their standpoint, if you're someone who has, very little income sources at retirement because you're planful and you have Roth IRA dollars and other sources, you're most likely not the same risk. So we see people change residency frequently. I myself don't have as much experience in terms of residency audits, obviously, as what Mike may have too. So I can't speak to the specific numbers, but I think like Mike said, it depends on where they're going to find additional dollars, or at least perceived dollars. And that matters a lot and is weighted in their eyes too.
It's an interesting point you make, Mark, to call it a return on investment. But if you think of the state Department of Revenue, they have a limited amount of resources to invest in auditing, and they're not going to chase around somebody who's driving a 1986 Buick LeSabre. They're going to go after the person who's got the big home and the jet and the Bentley, and that. So they do look at it almost as an investment, almost like fishing, right? Where am I going to catch the biggest fish?
So it's not a lottery. It's not an even chance. The young digital nomads or the retirees going to Portugal or something like that Wall Street Journal is writing about on Monday. That's probably not the same as the state of California saying, Elon Musk packed up and moved to Texas. Maybe we should take a look at this. The number of zeros make a difference, as Mike says.
Yeah, and I would add one thing too is, tax documents do matter. It's a quick system that they have. So if you have sourced income in states or different items like we've been referring to, just as Minnesota as an example, if your W-2 has the majority of its sourced income in Minnesota and you were in a Minnesota as a resident previous, they're using software and systems to try to track and find, oh, this is an easy one that we can try to review because of where all it takes is the coding and some of those items that are on tax documents to trigger different things from the IRS standpoint, from a tax side, and also from state.
Yeah,
Mark,
I think.
go ahead. Sorry.
I think that's a great point. Maybe we can talk on that a bit more, because there's different types of income that might be taxed and different characterizations of it, and that's pretty important. I can, without naming names, I have a few clients in mind who are looking at this or dealing with this situation, and it's one thing if you are a W-2 employee. It's different if you own a business that has been operated and domiciled in Minnesota, or in a couple cases we have people with like rental real estate. So anyone have any thoughts to share on that? Whether is this an all or none? Is it the portion of Minnesota income? What do we have to, John? Looks like you have a thought there.
I can relate to it personally. And so I was getting a W-2 from an Illinois-based employer. I had a kid enrolled at New Trier High School in Illinois. It would have been really difficult for me to claim Florida domicile with that fact pattern, despite the fact that I'd purchased a place down here and I would come down and spend time here. It wasn't until I left that employer, no longer received a W-2. My daughter had graduated, went off to college. We wound up spending more time in Florida. We did all the things that Mike and Mark had referred to, joined a golf club down here and moved the pets down here and all the other things that are typically required, that we were able to kind of make that work. But I will suggest to you that the state of Illinois, of course, came after us. They don't want to lose the revenue. They look at a number of factors. And fortunately, we had checked many of those boxes. That being said, I am still paying state income taxes to Illinois on rental properties that are located there. So we're not going to, in many cases, completely divorce ourselves from the state of Minnesota or Illinois if we do wind up relocating. In many instances, these audits wind up producing, and I know that Michael and Mark can probably speak to this more fluently than I can, it winds up being a negotiation. It's your legal representation arguing for you, and it's the state taking the other side of the equation and coming up with some sort of an agreement or settlement. Michael, have you found that to be the case in the cases that you've represented?
Yeah, and you have to remember too that you're sitting across the table from someone who makes, maybe in the high tens of thousands or low hundreds of thousands of dollars of income, and you're talking about someone who owns a $15 million home on Lake Minnetonka. it sometimes is they aren't real sympathetic to your situation. The one I was telling you about before, the client who had his shirts laundered at the Wayzata Laundry, even though he lived in Florida. And they said, how do you do that? He said, well, I put my dirty shirts in my jet and my butler flies it home and takes them to the Wayzata Laundry and flies them back. And we just said, we're not going to apologize for the fact that he's wealthy and that he spends his money on stuff that you wouldn't spend your money on. That doesn't mean he's still in Minnesota. They just know how much starch he likes in his collars. So, what I've found is that if you have documentation and you have records and you walk in with a big banker's box and you say, here you go, knock yourselves out. You look a lot more serious. You kept for example, we always tell people, if you're going to be in Florida, buy something at Starbucks with your credit card, or, use your phone and get a receipt, something like that, so that you can show, not only am I telling you I was in the state, I can prove to you that I was in Florida that day. The other thing, if you get to the point where you're counting days, that Minnesota does, which I think is, interesting, we'll say, is if you're in Minnesota for any part of a day, that counts as a day. So if you come into Minnesota and you land at 11:30 at night, you're in for that day plus the next day. So even people who make a short stopover, I think if you don't leave the airport, I could probably make that argument that you just stopped over. But counting days, there could be more than 365 days in the year, right? If I was in Florida part of the day and Minnesota part of the day, that's 2 days, one on each side. So you have to be very thoughtful about it. And if you're getting it that close, you're just asking for an argument with the Department of Revenue. The other thing is that, if you have a place of abode in Minnesota, that's one of the factors that they look at. You can't be a part-year resident in Minnesota if you don't have a place to live here, right? If you don't have a home or an apartment or whatever. People say, well, I'll sell my house and rent something. No, that's a place of abode too. But if you truly don't have any place to stay here, and if you come, you visit relatives or you stay in a hotel, that's a helpful fact. I don't know that it necessarily wins, but they're going to look at everything and keep track of everything. And at least then you'll have something objective to talk about. Otherwise, you're just he said, she said, or state said, I said, whatever.
Well, and so some of this may be a process too. So back to John's example, you've got Illinois. If you were in Minnesota and you had rental properties and you moved to Florida, and let's say you establish primarily at your Minnesota resident, Minnesota would still look and say, well, you own 2 or 3 or 10 rental properties producing income in Minnesota. We are going to tax those. So it's not all the income, it's that income. Okay, that might be a step in the direction that you want to go. Maybe you flat out sell some of those properties. Maybe use some financial planning techniques. You could maybe refinance them, take equity out, increase the debt so they're generating less taxable cash flow, right? Or maybe do something like a 1035 exchange into properties in Florida so you can sell and reposition your real estate portfolio in a more tax-friendly nature. So I can see some of these things, it might not be all in year one. Maybe it is a process of shifting.
And Scott, if I could interject too, that,
Yeah.
John, if you still own real estate, let's pretend you own the rental properties in Minnesota, and you die domiciled in Florida, but you own rental property or any kind of commercial real estate in Minnesota, you're going to have to pay Minnesota estate tax on that. Because what Minnesota does is it figures out your estate tax on your whole estate, and then it multiplies it by a fraction, your Minnesota property over your total estate. And that percentage of your estate tax is how much you owe Minnesota. So I've had clients that have a home in Minnesota and they leave it to charity, or they leave it to a spouse. And so they say, well, it's fully deductible, I shouldn't have to pay any state estate taxes. Ho, 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 that's not how it works. And clients just are furious about that. They've moved to Florida, but they kept a place up here, and now they have to pay estate tax. So it is it sticks to you. And you truly have to extricate yourself. The other thing you mentioned, Scott, is if you're one of those people who's an owner of a family business that generates cash flow, if that business activity takes place in Minnesota, doesn't matter where you move to, you're still going to have Minnesota source income. And, so it may not make a difference if you move, if that income that you're receiving is sourced from Minnesota.
That's exactly what we encountered. We have those rental properties in Illinois, despite the fact that we've moved to Florida, and my wife's family owns a business up there and she's a partial owner of it. And so that income is part of the minor amount of state income taxes we pay to the state of Illinois. But Michael, I'm so glad you raised the issue of state estate taxes, right? The conversation has been primarily focused on state income taxes, and that's the obvious one that gets everybody excited. I'm going to leave Minnesota, get away from the 985. I'm going to come down to Texas or Florida, and I'm going to save, significant dollars on the income that I'm earning, whether it's W-2 income, self-employment income, investment income. But the reason that many folks are leaving the state of Illinois is not because of the state income tax issue. State income tax is a flat 5%, 495 to be exact. In the state of Illinois, don't get seduced by the $12.07 million exemption that exists at the federal level, right? That's $24 million. A lot of people saying, I don't have an estate issue. Well, if you're a resident of the state of Illinois, the exemption amount is $2 million per person. And anything above that is taxed at 16%. And so there are maybe a couple of different issues. It's not just the state income tax, it's the state estate tax that's levied as well. And I'm glad that you introduced that.
If anybody's feeling bad about their Minnesota estate tax exposure, don't move to Illinois, because we have 3 million of exemption per person. So, the
3 million and then roughly 10%.
Well, it goes up. It starts at 13% and it goes up to 16% once you get to like 13.1 million or more. But at that level, you're paying federal estate tax as well, and your Minnesota tax is a deduction. So, when I've done projections, it almost always works out to be about 10% of the value above $3 million is going to go to Minnesota. When you factor in the reduction in federal tax that comes with it. Now, there's one caveat to that. And so if you make gifts in Minnesota, we don't have a gift tax. They tried that for about a half a year and it failed miserably. But if you make gifts and then die within 3 years of making that gift, the estate tax pulls those gifts back in and subjects them to estate tax. Now, here's the trick. The estate tax that you pay to Minnesota on a gift is not deductible against your federal estate tax because it's not attributable to an asset includable in your estate. So you're basically paying tax on tax on those gifts. So if you're making large taxable gifts and you think you're going to get that property out of your Minnesota tax base, it won't work if you don't survive for 3 years and 1 day.
There's certain phrases in our business that stick with me, and I always, reverse triangular arbitrage. I remember from corporate finance course, or interpolated terminal reserve. But the 3-year rule, isn't that gifts made in contemplation of death? Mike, am I remembering that right?
Yeah.
I always find that kind of a curious turn of phrase, like, I'm contemplating death. What's
well, I hate to say it, but this rule about the 3 years of gifts is our fault. Because there were advisors, I wasn't among them, I don't feel right about this, but that would say, oh, you're terminal, okay, get your checkbook, let's give away all your assets 2 days before you die, so you can avoid the Minnesota estate tax. And people did that, and so that's why they said, we want to have a gift tax. That didn't work out, but we'll prevent these deathbed gifts by creating this 3-year look back. So pigs get fat and hogs get slaughtered, and I guess we were hogs. But you're right. There's also a 3-year rule for federal estate taxes. It's a little bit different, but it's the same window. Equally troublesome, I guess. But
so one thing we spend a lot of time talking about with clients across the wealth spectrum, and I've seen, Mike, you made the comment earlier. You see folks who've moved away and then maybe in the very active early retirement years, then kind of kind of move back to be closer to family later on. But maybe I'd be interested in talking about some strategies if there is that window where maybe you have established residency and are in a lower tax state. And the big one is Roth conversions. We have some clients that are no tax state, and we look at that year by year and say, we can look at the portfolio as a whole, but maybe we break down and get inside the portfolio and say which assets look like they might be undervalued. Let's try and pay tax on those. We're still paying federal tax, but maybe we avoid the state tax on those Roth conversions. John or Mark, any other kind of related wealth planning strategies like that, capital gains, Roth conversions, things like that, if you are able to have a gap, a window, tax-free window, so to speak?
I'll let Mark go first, and then I've got a couple of thoughts on it.
Yeah, I can go. I would, like you mentioned, Roth conversion being one of them. It depends if we have a retiree that has is now on Medicare. There's always additional wrinkles that play into it where you can increase your income and then at the same time increase your Medicare premiums a couple of years down the road. So you have to be very careful and very planful about it. But anyways, if you are out of a higher income tax state, resident of Florida, for example, playing in whatever is in line with your financial plan, if there's ways to then knock over a couple dominoes of accelerating capital gains, diversifying your portfolio, Roth conversions, especially Roth conversion when we talk about what Mike referenced, which was estate tax. We can pay income taxes now, reducing our taxable estate. It's just another wrinkle that can play into it too. So I think you hit the nail on the head that there's items not only residency based, but then on your income level base of what you can plan and be a little bit more strategic about.
I love that idea. And the Roth conversion is something that many investors, I think, have overlooked. I know we all ran the numbers 10 years ago. Mark, you probably see this in your financial planning practice. Scott, I'm assuming you do as well. The idea that, the AGI limitations went away. Those rules changed, affording everybody the opportunity to consider a Roth conversion. People ran the numbers, but in many instances, they said, I'm not going to do it. Even though the math may suggest an advantage, I don't want to pay the current income taxes on the converted amount today. Well, here's an interesting idea, and it applies to maybe folks like me. I'm going to be retiring this year, and I'm 63. And so between 63 and age 70, I've got a window where my income will be lower before I start receiving Social Security payments, before I start receiving RMDs. There may be a window, not for a full Roth conversion, but maybe a partial one. Here's another interesting opportunity. Think about a client who was maybe COVID affected. They ran a gym or a restaurant or something where their income was down. And so do me a favor, take a look at the chart before you. These are ordinary income tax rates for 2022. If last year my income was $180,000, it puts me in the 24% marginal bracket. I don't get to the next marginal bracket of 32 until I'm at 340. I've got over $150,000 of income capacity where I, or the client in this case, could do a partial conversion, recognizing the income at a lower marginal rate today in exchange for the advantages that I'm sure you're all familiar with, right? The tax-free growth of the assets, the payment of the taxes, which lowers the client's corpus today, the avoidance of RMDs because they're not required on Roth accounts. So it's not always an all or none proposition. Let's look for unique opportunities like that, retiree window, and maybe the client who suffered a decline in income in a given year.
Yeah, I really like that point of that. This isn't a binary proposition of yes or no. And Scott, you probably notice this all the time with clients when you're doing planning is there's ways to meet in the middle and to view it of here's our situation. And yes, I understand the benefits of a Roth conversion, and there's additional reduction of risk, because we don't know what tax rates are next year, 5 years from now. So diversifying yourself not only in how your investments are laid out, but the tax diversification of partial conversions is something to keep in mind.
Absolutely. Yep. Yeah, I love that concept of a window. We talk about that a lot. John laid out a couple other factors there, Social Security for a lot of folks, if they're generally healthy and think they have pretty good life expectancy, we're often talking about delaying, and RMDs have been pushed back, required minimum distributions, a couple more years, 72. And so have that window to look at. And very often we are, if we think about that tax structure as like a measuring cup that you fill up, we're saying how much room do we have before we hit that next gradient. And I like John's chart, with the last tax law changes, I look at that, for that 22 to 24% band is really fat these days. And even going from 22 to 24%, it's not that big of an increase. It's a very wide band. So we are often taking a look at saying, what can we do voluntarily pull forward as a income tax Roth conversion? Even better if it's in Florida, Tennessee, Texas, Nevada, Alaska, even, John, and get it converted. And then, maybe when you are in your 80s, like Mike says, and you move back to Minnesota for, the good food, good weather, and good jokes, it's like a jack in the box, and that those dollars have grown tax-free in the wealth in the Roth account there. We have
I'm sure anybody who's talking to the advisors on this call would get this advice, but let me just say, if you're thinking about a Roth conversion, make sure that you have assets outside of the IRA that you can use to pay the tax. Yeah. If you use the IRA itself to pay the tax on the Roth conversion, you're just eating yourself alive. So Roth conversions aren't good just in the abstract. You have to have all the facts right. Yep. In order for it to make sense.
Quite a bit there. I'll mention it. We are recording this, and so I know I see some questions popping up. We will be able to share this, and I had gotten several clients that said they were interested but just had conflicts. We'll be able to share with them, but we have a nice flow chart with considerations for moving states. We'll be able to share that, and we have similar ones put together for Roth conversions, and certainly we're all available for conversations. Maybe one sort of specialty area that I wanted to touch on, just because we do work with quite a few corporate executives. And John, I know this is an area you've spent quite a bit of time on, but when we look at things like stock options, restricted stock, non-qualified deferred compensation, that's a big one. What about state sourcing and rules there? Is Minnesota going to get you? Is it depends? Anything to share there?
Yeah, the answer is it depends, and certainly you want to take advice from appropriate legal or tax counsel on these issues, as opposed to the general financial planning advice I'll be providing now. So we know that there are two primary forms of equity compensation. It's the restricted stock grant, either restricted shares or RSUs, and then your employee stock options, either NSOs or ISOs. Here's the deal. With restricted stock, generally speaking, you don't control the timing of the event. It's going to be taxable when those shares or units vest. One exception under 83B, a little bit complicated, but by and large, it's a non-controllable event. The vesting of that award determines the timing of the taxation and obviously where you're going to pay both federally and state. With options, you have a little bit more control. With options, it's not the vesting of that award that determines the timing of the event. It's when the individual, the recipient, actually exercises. They convert that option award into physical shares by either using their own cash or borrowing money. Now, whether they sell the stock or not is kind of irrelevant. With non-qualified options, it's my exercise. Even if I hold the shares or giving them away, that's going to determine the timing of the event. With non-qualified deferred comp, otherwise known as 409A plans, these are plans that allow highly compensated individuals to set aside more money than they typically would be allowed to do in a traditional qualified retirement account, like a 401k. We're talking about the opportunity maybe to shelter hundreds of thousands of dollars, maybe a large percentage of your year-end cash bonus. The trade-off there, am I better off not receiving the income and investing 100% of that capital today, and then eventually paying ordinary income taxes when it comes out later on? Or am I better served recognizing the income, paying taxes, and reinvesting the net after-tax amount? And there's some math involved. People like Scott, of course, are great at doing that math for you. Here's the deal at the state level. That sourcing income term that you use, Scott, is a key driver, right? And so I go ahead and I earn the income and I defer it while I'm in Illinois, and then I move to Florida, and all of a sudden I take a distribution next year when I retire. That's not going to fly. There's a 10, generally speaking, every state varies. There's a 10-year distribution or life expectancy distribution that is required to avoid sourcing that income back to the original state where it was earned. I don't know if Mike or Mark have any additional comments or want to provide any additional depth on that issue.
So, John, you're saying if you're an executive in Illinois or Minnesota and you're packing money away in your non-qualified deferred compensation plan, you need to be out of the state for at least 10 years before they'll kind of drop off pursuing those dollars? Is that what I heard?
Distribution over a 10-year period of time as opposed to a lump sum distribution that is generally looked at in determining the state in which it's going to be taxed.
I see. But if you had elected, and that's the tricky thing, because you have to elect this before you're making the deferrals these days. And if you'd elected a lump sum or a lump sum 1 year after retirement, and you say, hey, I got to get down to Florida, that's not going to work. And you get
it's a negative surprise to many individuals. I go ahead and I defer. I go ahead and, hey, my friend moved to Florida. Maybe that's a good idea for me. I wind up going down. I take distribution from the non-qualified deferred comp plan, and all of a sudden I'm surprised with a tax bill. It gets to the point, Scott, which you and our other guests have made so clearly throughout this conversation. You look at the gross rates on that beautiful chart that I put up before. There's a lot more to the planning process than just comparing 985 versus 0. You got to dig a little bit deeper, determine the source of the income and how that might be taxed state by state.
Absolutely.
Mark looked like he had something to weigh in on there.
Yeah, I was just going to second what John had mentioned. From a tax side, how we see it is exactly that. Is if it's under that 10-year rule, then they source it as a W-2. And then it gets sourced to your state in which it was earned, versus what we've seen, at least from some other highly compensated individuals after retirement, is if it is longer than the 10-year rule, it's on a retirement tax document and doesn't necessarily follow those state sourcing. It's on a 1099-R from a tax technicality standpoint. But no, I think everything aligns with what we've seen in practice on when we're running through all the tax returns this past year, and definitely agree that you have to be planful on the front end, not as much that you can do on the back end of it.
Hey, I want to throw out an interesting idea here that may reverse this trend of relocation. And it's you may accept it or you may dismiss it. You ready for this? So what's been the big impetus behind relocation? It's the Tax Cut and Jobs Act that passed a couple of years ago. And it said, wait a minute, we're going to lower your marginal rates from 39.6 to 37. We're going to keep the capital gain rate at 20, but the big changes are on the deduction side, right? We're going to increase the standard number to 25,900 MFJ this year, and we're going to limit those itemized numbers under Schedule A. We're only going to give you charitable gifts, mortgage interest, medical expenses if they exceed 7.5% of AGI, and we're going to give you a whopping $10,000 to cover your property and your state income taxes. And so people like my brother, who said, wait a minute, I'll be a California resident when the feds are subsidizing me, right? I'm getting a 40% deduction for the big state income taxes I'm paying in California. But now that I own the entirety of the bill, I got to move. Mm-hmm. Well, what happens when TCJA expires at the end of 2025, I think, Mark, is that, becomes effective again in 2026? What happens if the SALT tax deduction cap is eliminated and now I get to write off the full amount of the state income taxes paid? Maybe that new math changes my decision, or at least influences it to a certain degree. Just a thought.
Yeah, you heard a lot, or at least I've seen a lot of headlines about, folks from New York heading down south because they couldn't deduct their property and state income taxes. So very interesting point. We're getting close. There's two other kind of topics around. Mike, can you talk about perpetuities and some of the trust thing in 2 minutes?
Sure. Yeah, well, that's one of the things that people think about when they're doing estate planning. If they're setting up trusts for kids and grandkids, how long can they last? And Minnesota is one of the states, one of the many states that says a trust can last for the lifetime of all the people who were alive when it was created, plus 21 years, or 90 years, whichever's longer. Minnesota has that version of the rule. Other states have either eliminated that limitation or made it ridiculously long. For example, Colorado has made it 1,000 years, not 90, but 1,000. Florida is 360 years, Arizona 500 years, Wyoming, big sky country, is 1,000 years. So if you are interested in true dynasty trusts, the place to set one of those up is in another jurisdiction that doesn't have this limitation. Now, I always tell clients, if you're concerned about giving too much money to your kids whom you raised and whom you know, why are you interested in leaving money to people 4 generations from now whom you've never met?
Yeah.
So it is kind of an interesting question, but trusts can last forever in South Dakota, for example. How do you get there? You have to have somebody in South Dakota managing the trust. You have to have a trustee located there. And we don't have time to even touch on it, but there's this whole separate state income tax question, which is, when is the income on a trust taxable to a specific state? And maybe we have to do a follow-up session on that sometime, Scott.
Yeah. Maybe if I can sneak in one more quick one. Asset protection. Maybe John or Mike, any thoughts? You hear this come up, and I'm certainly not an expert in this area. I know a little bit. I know some of the issues. Minnesota is not particularly protective or friendly if you're being sued, but I hear, say Florida or Texas are much more, and that kind of gets in this whole puzzle. And in fact, I've heard, I don't know, is this true, John? You can go to Florida and buy $1 million house and it's protected day one. Do I have that right?
I'm going to let Mike weigh in on that. Mike,
Okay.
can you save me from litigation down here?
Get you out of the hot seat.
I can tell you that, from popular memory, Enron, Ken Lay, I think, had a very valuable home in Texas, and the equity in the home was protected from the creditor's claim. So many people do, advise, pay down your mortgage faster, get as much equity built up in your homestead as you can. That doesn't work so well in Minnesota. There's a certain amount of equity in your home that's protected, but not unlimited amounts. Now, the flip side, Scott, is that if you got money in a trust from a relative or a third party, that's virtually bulletproof in Minnesota, what we call spendthrift trust protections. But in Minnesota, if you create a trust for yourself, creditors can get at it. There are some states, Nevada is a classic example, where you can set up a trust, put your own money in it, and say creditors can't get it. So there's a new frontier there that, the law hasn't really developed, but Minnesota decided deliberately not to allow that. So if you get sued and you have money, it's going to go to your creditor. You can't get around that by putting it in a trust. Other states don't mind that, I guess.
Yeah. Well, hey, this has been fantastic. And I think we accomplished going deeper than a surface scratch, but obviously there's so much more that could be talked about here. I really appreciate you all coming together, and appreciate the attendees, our wonderful clients, Cahill team who helped coordinate this, Anna and Kevin, and Alex White at PIMCO is also very helpful. So John Nersessian with PIMCO, thank you very much. Mark Gassner, Ellingson, and Mike Sampson. And I mean, begging you guys to come together again, maybe another topic. This was a lot of fun. So appreciate it. Thank you all. Take care.
Bye, everybody.